thank you so much. So same thing for the opposing side going down. It opens here because this one previously closed here, right? So it's just gonna turn around at the same position where the last one closed, head down, maybe head up a little bit, and then ultimately close here, creating the body. Super, super simple. You could watch the 1 minute candles print out all day long if you want. If you've been guilty of that, especially on US 30, let a girl know. How do I get out of here? All right. So another thing I want you guys to remember is that there's intention between movements or throughout movements, okay? Remember that this is a $6.6 trillion a day market. It is the largest market in the world. And we have all the big boys playing and the big girls. So we got JP Morgan, Citibank, HSBC, Dutch Bank, Merrill Lynch, Bank of America, etc. You name them all, they're participating. Not only that, but they have their best friends with bigger pockets or deeper pockets also participating and adding some extra volume in there too. If you want to go ahead and hop on the biggest search engine in the world, Google, you will see that you could actually find articles of the banks being fined for rigging the market. So the market is an algorithm. It's showing us visual representation of price in real time. And for every position that is opened, let's say, for example, a buy position, there was an opposite position of the other side, opposing position. So for every buy that I take, somebody else is taking a sell. For every sell that Johnny takes, someone else is taking a buy. So that's how that works. So we want to make sure that we we touch on how to read what kind of looks like hieroglyphics the first time that you hop on here. So let me go to a bigger time frame. I think this is where I was at before. Let's see if we find this again. Yes, perfect. Okay, so candlesticks, right? Different time frames. Let's pretend that this is a 4-hour time frame. Biscuit. We're only looking at the right side of the cursor, or the left side. I messed that one up. We're only looking at the left side of the cursor. That's a 4-hour candle. The way that it kind of looks broken down on maybe that example didn't work. Let's pretend this is a 5-minute candle. The way that it's broken down into 1 minute time, into the 1 minute time frame, is just making 5 1-minute candles equal 1 5-minute candle. So it opens here, right? It opens here, it opens here. It goes up, it closes, it goes down, creating this wick. It goes down, creating the bottom of this wick. It comes back, creating the top of this wick, and then ultimately closes here, creating the bottom to the top, creating the body. All right, I know we can move on from the anatomy of that. So where do institutional concepts come into play? I want you guys to remember who puts out the information. I want you to remember he, she, them that control the information. That says a lot. It does a lot. There's a lot of effect to that. So remember that. Who's putting out the information? Remember that the rich will continue getting richer because they have leverage, and some of that leverage is media. So if we go to Baby Pips or Google and look up candlestick patterns, what are we going to find? We're going to find this candlestick cheat sheet to make your life easier, allegedly, sometimes to confuse you. So we can look at different types of candles. You can name them dojis, hammers, stardust, stargazing, who knows what, right? Let me know if you guys could still see my screen, because sometimes that happens. Can you describe a 1-hour time frame candlestick? Yes, that would be 60 1-minute candles divided by 5 is what? 11, 12? 12 5-minute candles, 4 15-minute candles, 2 30-minute candles. So you could just basically break it up. A 1-hour time frame candle. 4 of those guys will create a 4-hour candle. So going back to candlestick patterns, they teach you these reversal patterns. They teach you that when momentum is losing, or when price is losing its momentum in one direction, you will see the exhaustion, you will see the wick, you will see the doji, right? And then price will go in the opposite direction because that's how things work, allegedly. So what I want us to kind of focus on is look at your charts. How often does that really happen? Let's look at it this way right here. So price is coming down, right? It's melting, it's melting, it's melting. It creates these dojis. Yeah, price comes back around. And same thing here. It creates smaller and smaller and smaller bodies, kind of squeezing, if you will. Smaller bodies here, smaller bodies here. Let's go ahead and highlight this area so we know exactly what we're talking about. Oh, that is. Send it to the back. Okay, so we're looking at these 4 candles. Price, or Google, tells us that when price is slowing down and wants to come to the opposite direction, they'll have wicks showing exhaustion, small bodies showing that there's no momentum in either direction, right? But then look at what happens after. Look at the proof. The proof is in the pudding. So after price does that, why is it that price continues to the downside, leaving a huge wick down here? Which, if we know that if we break this down into smaller time frames, it really just means that smaller time frame candles are really pushing down here. So we can go ahead and zoom into this area on, let's say, the 15-minute. Oh man, I got lost. I didn't see the date. There we go. Okay, now I could go down to 15-minute. Damn it. We are on this side. No, we're not. Follow the green line. Why am I so lost on this? Okay, that seemed like an excessive amount of scrolling. Okay, so notice that these were small candles on the 1 hour, right? They're even showing us really small candles. Let's focus right here. They're even showing us really small candles on the 15-minute. This is supposed to be indecision, right? And then how come it continues to show these small candles, zero body, all wick, and then this guy comes in here? If retail traders were to have, or were to be going with retail information, you know, saying that this is support, exhaustion, price is turning around, engulfing to the upside, exhaustion, dojis. So if people are buying in this area, putting their stop losses in this area, right? Let's just say around here. Then why does this candle come in so aggressively before making higher highs? Before really showing us the impulse or the directional bias? The bag, the monies, yes. 3 guys plus an ostrich. I'm confused. My money. So John's money is sitting down there, and John's money got snatched out of his hand, right in front of his eyes. He was watching his trade, and then it hit stop loss. But good thing Johnny put a stop loss. Some people don't do that. Read this chat. Taking everyone's stop loss. Exactly. My money's up here. All right. So the question is, you should, I guess it's not a question. The statement is that you should be questioning the information put out there, the free information, the information that's easily accessible. I I used to say that if it's not on the first page of Google, it doesn't exist. However, now I'm just like, everything that's on the first page of Google is paid programming. So there's money behind that too. So notice all these equal lows, movement to the upside, equal lows, equal lows, equal lows, equal lows. And then if price wanted to slow down, it's kind of like a turning car, right? If you're going 45 miles an hour and you wanted to turn left, then you would slow down before turning left. But they didn't. They did an aggressive push, an additional push down before creating that higher high. And then notice, this is where we also want to find, this is where we're also doing our investigating, right? Notice how there's no opportunities, no opportunities for sellers. These are all blue candles. This is the imbalance. For every position open, there should be an opposing position. But here, we don't really have too many sellers. So all the volume is going to the upside. So that's just something to keep in mind. If we wanted to go ahead and let's do something like this. Let's do that. This is, go ahead and guess, an uptrend. Right, we have a higher high, a higher low, a higher high, a higher low, and a higher high, creating an uptrend. Cool. Now let's go ahead and change these colors, and we're just going to break it down on smaller time frames, because for every big time frame, everything is fractal, right? So let's pretend this is a 4-hour time frame. If we break it down into what it would look like on a 1-hour time frame, then it would look like something like this. So this is still a bullish trend on the 1 hour, but for every correction, it's going to look like a break of structure and a different trend on smaller time frames. And then same thing here. We have the extension, we have the correction, we have the extension. Oh, that's where it went. So just continue it. My point being, we want to go ahead and break this down, know where you are, stay organized, because how is it that we can go, doing top-down analysis on a brand new chart or a brand new pair, go from the monthly to the weekly to the daily, making sure that we're looking at relevant information, somehow find ourselves on the 1 minute sometimes and not be lost, right? Because it's so easy to think that we're on a bearish trend when really it was just a correction. So if we're down here, why would we continue to sell if we're already at lows? If we're down here, why would we continue to sell if we're already at lows? And we know that at a bigger time frame, if we look at the bigger picture, it's looking like it's a perfect time for the reversal back to the upside, which is why it's so important to just stay organized and then remember what is smart money's agenda. So back to the candlesticks and just kind of understanding what's going on. And I think I touched upon this last week, but let's just go ahead and do it again because we're talking about the anatomy of a candle, right? So wish I could. We'll stick with this example. So the reason why price has to come to what we'll do is talk about a little bit of vocabulary. So the reason why price has to come and mitigate, right? Mitigation means minimizing their losses because the banks don't lose money. They simply put it aside and know that they can come for it later. They have that kind of volume, they have that kind of cash, they have that kind of leverage, and they have that kind of power to move or manipulate price into their direction. So they can put temporary, let's see. They could put temporary sells here. Let's make this candle, oh, I don't want to do that. Let's not have that there. Let's change this color. A bearish candle could be black, for example. Where's my black? Okay, let's say it's gray. So if this is the additional push down and then price makes a higher high, where is price going to come down to in order to mitigate out of this loss? So let's go ahead and put, we could do this line because this is the kind of line that I usually do. At the opening, right? We learned that the opening of a bearish candle is at the top. At the opening there, then price makes a higher high up here. And then price has to go back, push down back to the same area where price was when they opened this position in order to mitigate their losses before continuing the trend. So remember that they're thinking long term. They're also thinking something like this. How can we screw as many people over out of their positions? Because for every stop loss hit, that position is going back, is being sold back. For every stop loss hit, that position is being sold back. So if people are seeing what they call ceilings, right? Resistance, and they're selling, and they're selling, and they're selling, and maybe they're even trailing, then let's go ahead and actually find that example. I think AE had a really good one. Not the 15-minute. Here we go. So if we have both support and resistance here, how can we screw both of these sides? Notice the anatomy of the candle. When they're small, it's supposed to be indecision. It's supposed to be turning around, right? So why didn't price, if price was supposed to turn around, it's coming from the upside, why didn't it go straight down from here and make engulfing candles to the downside, right? So what it had to do first is accumulate the positions. People are seeing this and they're buying here, 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 because they're chasing the trade. They're even buying here. They're chasing the trade. Now, we also have the opposite side, the opposite end, where people see the ceiling or resistance and they're selling here, 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 here. So where are they putting their stop losses? Right above for the sell, right beneath for the buy. So just think about the information that they're teaching us. The information found on babypips.com. The cheat sheet to make it easy for us. Just think about how it correlates, or I guess not so much correlates. And what's up with this guy? Like, I think I went over this exact same training, but this right here just goes ahead and shows that there is manipulation in the market, that some people have an agenda and they're out to get you. Let me put that in the back. Because they don't teach us this anatomy. They don't teach us that a wick is going to drop 48 to, wow, a lot of pips. What kind of 1 hour candle drops 80 pips just in the wick? Not only that, but how does it drop 80 pips just on the wick to the downside and then end up going up? That's a huge difference in price. So remember that when you see equal highs and equal lows, it's not your cue to get in. If everyone else is doing it, you don't want to be doing it. You want to be on the right side of the money. So if people's money's here, and then the banks are like, okay, well, how can we screw them both up? Maybe people are still entering in this area. maybe their stop loss is at the previous high. So even if this didn't get people out, which it might have gotten these positions out, putting stop loss at this previous high, then just in case price went all the way down, took out these folks, notice that there was also some movement over here where people also had stop losses. There was also a push down, the impulse up. So remember that the banks don't lose money. If we put this line at the opening of this candle, the one that pushes to the downside, but then ultimately it doesn't continue to the downside, it continues up. Notice how this one came pretty damn close to that same position. So this was minimizing the bank's losses. The banks don't want to have 100 lots and be 152 pips in drawdown at 100 standards, at 100 million. They don't lose that kind of money on a Tuesday. Maybe temporarily, but only because they know that they can manipulate price to come pretty damn close to where the movement started. Awesome. So now they manipulated price back here so that they aren't at these losses anymore. Created this so that people would be buying and selling. They knew price was going to return back down there. So this was going to be wiped out anyway. Later, these positions are sold back. And then if that wasn't enough, let's continue price to the upside just in case any people were left in these positions. So let's go ahead and take them out of their positions. And then just like that, the banks manipulate price, they move it, they take people out of their positions and make people lose money. And then we have the same thing happen pretty much again. So people's stop losses here, an extra push to the upside, and then price melts, right? So there's no buying opportunity but within these 4 or 5 candles. Then price kind of shows, okay, they're slowing down the dojis, right? The dojis means that allegedly price is going to return back. It doesn't do that. In fact, it kind of moves sideways a little bit, creating more dojis and then an extra push to downside. But remember that this position was open that screwed up people before, and the banks don't lose. So they had to bring price back pretty damn quickly so that they could close out these positions, and then price can do its thing and move back down. So the agenda is, like Jenna likes to ask, she asks, what's smart money's agenda? Smart money's agenda is to screw over as much as retail as possible, whether it be just one-sided or both-sided, whether it be immediately or they could wait. They could play the waiting game because they know ultimately they could just move price back. So price will continue doing that. And I think the easiest way to kind of prove it would be to question everything that you learned on babypips.com, or if you came from a different just kind of education, if you're watching YouTube videos or studying these candlestick patterns, test them out. More than anything, test them out. If you see dojis, what usually happens? Notice how here again, we have it engulfing to the upside, price moving to the upside, price moving to the upside, creating smaller pattern or smaller candles. So shouldn't price be coming back around? Instead, it continues to the upside. So start testing it. When is it working? When is it not? What is smart money's agenda? What is price doing now? Who can I screw out of their positions? Stuff like that. So start just annotating it. Start looking for it. Then the candles will actually make sense. But remember that banks, institutions, the Federal Reserve is not looking at candles. They simply just know what we know, because they put the information out there, and then their agenda is, okay, well, how can we get these positions back? How can we minimize our losses? How can we pump into the market? Because with all this chaos going on, they used to say, well, I guess on average, the market is still 6.6 trillion a day, daily turnover on average. But in the midst of chaos that was, like 2 weeks ago, when the market was just plummeting, when US 30 made that huge move into the downside, the daily turnover for the foreign exchange market, the currencies market, actually got up to almost 8 trillion. So that was a lot more positions, a lot more opportunities for banks to come in, for manipulation to be made, because there was just so much chaos. I mean, the market itself, the crash, the recession, COVID, it's all chaos. It's all, okay, turn your eyes to this so that you don't have to be seeing that. It's all, I guess, what's the word? What is the word? Okay, I'm blanking. Divergence? No, I guess. I feel like someone will help me out in the chat here. Who related? Yes, related. But I'm thinking of a different one. Anyway, we won't get stuck there. Distracted. Thank you, Alana. It's all a distraction. That was really bothering me. Thank you, guys. I appreciate you. You have like brain farts throughout the day. So look at the size of the candles. Look at the time frames that you're at. Look at, does this make sense? Is this natural? Remember that for every buy position, there should be an opposing selling position, right? For every up movement, there should be an opportunity for the down movement. When there is none, that's what we call imbalance. When there is none, we find imbalance, and the market should be balanced out. One team, one point. Yes, thank you. One band, one sound. I never heard that, but I like it. So start to test these things out. Test whether the candlestick cheat sheet works. Let me know. Because as yourself, I mean, at least for a few of us that have been here for over a year and a half, or over a year at least, we were following this, which is why we couldn't find any consistency, because the information that we were learning and what was actually happening in the market just wasn't adding up. So there was something fishy going on there, right? So when Zach and Jordan and Mike and Rock and Sandy and Zachary McDonald, they've been testing certain things out. They've been looking for, okay, what's actually happening? Let's actually get behind this. It's like playing a game of Clue. Like, we have to find out people or the market's real intentions. Drumline, okay. So it just makes it so much easier to understand. Learning that there is manipulation in the market, learning that there can be an impulse to the opposite side, and then it comes back to that same area. Like they say, there's only so many coincidences that can happen before it's just like not at all a coincidence and proven so. So you can go ahead and test these candlestick patterns out, this cheat sheet that they're giving you, free will, putting it in front of your face, putting it in the first 6 pages or the first 6 images of Google. Or you can go ahead and see what's smart money's agenda. What are they actually up to? If the banks wanted to give out free money, everyone would learn Forex. Everyone would learn trading. They would tell us or teach us how to set standards right away, or operate with standards right away. And then, let's see. So consolidation, you don't want to trade in it. Don't trade in the squeezing. Don't trade the support. Don't trade the resistance. Instead, know that there's something on top or below it. Know that the masses are doing it. Know that you don't want to be like the masses, because if 96% of traders aren't successful, where are 96% of traders getting their information? Don't be the guy to just follow. You know, you don't always have to be the sheep. It's good to be coachable, but don't be a goofus. More than anything, like, don't take my word for it either. Go ahead, get into your chart, hop on TradingView, test these things out. Don't just test them out on the 4-hour. Look at how fractal the market is. Test them out on the 15-minute, test it out on the 5-minute. Don't get lost, but you have the opportunity to test it out on the 1-minute. Appreciate you guys. So things to look for. Basically, everything that they teach for free, question it, and there's a good chance you're going to use it, but not for the reason that they're showing you. If they're teaching you support, don't trade it. Wait for the manipulation to happen, for the real impulse to happen, and then get in on the mitigation. If they're teaching a resistance, same thing. Don't sell at the resistance. Wait for the manipulation to happen, that institutional candle. Then wait for the impulse to show you the true direction, and wait for the mitigation. Those are your safe entries, where you don't have to have 50 pip stop losses, where you're not going to get stopped out and then the move is being made. Like, the reason why we have a course to begin with, the Trade House training course, is because someone, or a few people, thank you for the pioneers, have tested this out over and over and over and over and over again. And they've done so responsibly. So it's not like someone is just selling their strategy saying, this is how I made $40 million, and that's it. It's like, this is how I've turned a little into a lot over X amount of time, risking a consistent amount that's not going to stress you out. So don't fall for, hey, doji, well, price is turning around to the opposite direction. Don't fall for support. Don't fall for resistance. Test it out. Don't even take my word for it. Like I said, that's really all I think I really have on the anatomy of a candle. This is a super, super basic concept. But for anyone that is in their first 2 weeks of trading, that hasn't finished the Trade House trading course, go ahead and just spot the candlestick patterns. Go ahead and spot the support and resistance, the equal highs, the equal lows. That is your liquidity. That is not your friend. You are not getting in there, but just see how it responds to it and have patience. Patience will pay, or at least it won't stop you out over and over again. But other than that, let's stay tuned for the calls that are coming up this week. We have the rest of the week is going to be fundamentals of smart money concepts. So we have Chairman 10, institutional trader and go live educator El Mago hopping on the charts for the rest of the week, and also having some of his pretty much, what do they call, apprentices, prodigies, coming up to show that this is duplicatable more than anything. It's not just one guy making money. It's not one guy selling a strategy. This is why we know this works, because we have 3-figure traders hopping on almost every day. We have 4-figure traders being popped like nothing. The team is growing. People are succeeding. The only reason why more people are coming in is because what we're doing is working. It's actually being proven to work and not just people getting lucky. This is duplicatable. The same way that I trade, I could teach, well, shoot, Ariana's already learning, but I could teach someone else to trade in the house. I could teach my cousin's niece's nephew, for example. Anyone that's willing to learn, coachable, and pretty much absorbs information, they can hop on the charts and see the same thing. So with that being said, fam, hop on the sessions that are up tonight. Tomorrow is Tuesday. We have Bounce Back at 2 a.m. Central Time, Bounce Back at 8 a.m. Central Time. We have Zach and Jordan. We have Mike after Bounce Back. We have Bob Proctor at 8 p.m. Tuesday, Wednesday, and Thursday for a 3-day mastery course. We are abundant in all of our resources. It's just up to you to be resourceful. But with that being said, I appreciate you guys for listening to me talk about the anatomy of a candle. It's super interesting, but definitely applicable. So it will pay you. Patience pays. I appreciate you guys. Have a blessed night.